Well, good morning, ladies and gentlemen. Welcome to what I think is episode 12 in our series of entrepreneurial and private client webinars covering a whole range of topical, interesting issues that we think are appropriate or people have asked us to do. Today, we're talking about group structures. Just before we kick off on that, the usual introductions. My name is Patrick King. I'm a tax partner, head of entrepreneurial business. And I'm joined, as I am often, by James Kipping, another partner of mine, head of private clients. So we'll be your entertainment for today. Right, so let's move on. Went quickly through our disclaimer slide there. So what will be covered today? Well, I'm going to deal with the introduction. I'm going to deal with what is a group, because obviously it's all very well talking about it, but not everyone necessarily knows what we mean when we talk about a group. Then we'll have tax reliefs and exemptions. I'll cover most of those, including a reference to what is item 4 on that list there, substantial shareholdings exemption. But James is going to pick that one up and give you a lot more detail on what is probably one of the most important reliefs available in the group or tax world for group purposes. Then he'll deal with groups and inheritance tax, some weird quirks in the way inheritance tax works with groups of companies that you probably wouldn't expect. It catches me by surprise every time I look at it. And then what happens perhaps later on in the cycle when you've got your group, you've been trading happily, and you want to start breaking bits off that group or demerge bits from it. So it demerges, and then we'll take some questions at the end if we have any. So you can go to the next slide, please, James. And the next one, introduction. So we've looked in past webinars at what business structure you might like to operate your business in or from. We've considered just operating as a self-employed entity. We've considered whether you want to perhaps end up being in a partnership or a limited liability partnership, and we've looked at limited companies. What we're doing now is looking at a situation where you perhaps have more than one activity, more than one trade within your company, or more than one activity that you want to take forward, and how you do that, whether you keep going in one company with multiple trades or whether you look to have more than one company and how you might organize it. So there's various ways that you might do it. You may, for instance, have 2 distinct trades and decide to operate them in 2 distinct companies. They may be owned by the same people, but they're just 2 separate companies. And that's what we'd call, that's not a group, that's what we call sister companies, or you could say brother companies, I suppose. They're related to each other because they're owned by the same people, but they're not in a group. Another alternative is to continue with a single entity, but divisionalize it. So you have different trades operating within divisions for administration purposes within a single company. That may be sufficient. Often though, as the business expands and as you start doing more diverse operations, or where you perhaps take on something new that has significantly extra risk, it does make sense to put it in a separate company. And there are then often advantages as to why you want to do it within a group structure. So if you go on, we then obviously need to consider what is a group. I've got a couple of these slides which say statements like that, and there's nothing in them, but here's the next slide. What is a group? So the group structure is a situation where one company controls other companies, basically. You can't have a group without that company at the top that owns the others. And very simply, there are 2 types of group. You can have the vertical group, which is the one that on the left of the screen as you look at it, where you've got parent owning subsidiary 1 and subsidiary 1 owns subsidiary 2. And that can obviously go as far down as you'd like. And then you have the horizontal structure where parent owns subsidiary 1, 2, and 3 underneath itself. So it owns them directly. They don't own each other. They're not linked to each other other than via parent. And from that, you can build incredibly complicated structures covering multiple pages and multiple spreadsheets when you get into more complex structures. If any of you have done a family tree, for instance, and traced your lineage back to Oliver Cromwell or something, you will have seen big sheets of paper with countless graphs on them showing who's related to who. It's a bit like that when you get into large groups of companies. But essentially, you have a top company which owns the rest to a greater or lesser extent. So why would you want to form a group? Well, we've sort of alluded to some of this already. But there's a few examples here. So, I mean, protecting the crown jewels. You may have been trading quite successfully for some time in your single company. You've built up some value. You may have you may have bought the property from which you trade. For instance, you may have other properties that you may be holding as investments. You may have built up a pile of cash which you're keeping for future purposes. You may even have investment assets that you built up within the trade. And what people start thinking about, sometimes on their own, sometimes because we suggest they do think about it, is what happens if something goes wrong. All the assets you've got within your single trading company are at risk from the trade risks that company is undertaking. If something goes horribly wrong, the company's sued or some disaster which causes a problem, then all those assets you've built up, the property you've built up, the investment portfolio you've built up, the cash you've built up, could potentially be at risk. So one of the reasons for setting up a group structure is to try and protect those crown jewels, as we call them. So you might, for instance, move all those assets you want to keep away from trade risk into a holding company and have all the trade in the company below acting as a trade subsidiary. More on that in a moment. That covers the next one, really. You do have to watch, though, when you are putting your crown jewels in a top company, protected and away from the trading risk in a subsidiary, you do have to watch parent company guarantees. It's fairly common for banks and possibly other creditors to seek a guarantee from the parent company, which can, of course, then bring some of those assets back into risk. But apart from that, having it in a separate company, even with the same group, does give you some fairly genuine protections from trade risk in the trading subsidiary. There are also regulatory benefits. You can file group accounts and so on. There are some benefits for having it operated within a group structure. You can centralize certain functions or activities. For instance, you might have all your properties in one company within the group and all other companies use those properties. You may have your management, your admin, your finance functions in one centralized place, providing those services to the others. You may put all your R&D activities in one company. These are all just common ways of dividing the functioning of the business between group companies. But the most benefit is distinct trading activities make more sense to be put in different companies. I have one client that operates as a single company with multiple outlets in their particular field, shops, if you like. I mean, they're not shops, they're restaurants, but they operate on a divisional basis or a regional basis. If they sell individual outlets at the moment, there's a capital gains tax charge within the company because they've sold an asset of the company, and if there's a gain, they have to pay tax on it. If, however, they put each separate outlet or each region within a separate subsidiary company, and then perhaps sold those companies for whatever reason, they could potentially benefit from the substantial shareholdings exemption and pay no tax. And James will tell us a lot more about that a little later on. There are plenty of other tax benefits for operating as a group. There are reliefs and exemptions for transactions between group members, and I'll talk about those in a moment. If one company makes a loss and another company makes a profit, then within a group, that loss may be surrenderable across, so you can claim benefit for other companies' losses. I've mentioned the substantial shareholdings exemption already, so if we can go to the next slide, please. So how do you form a group? We've talked about why you might want one. We've talked about roughly what they are, but how do you actually form it? Again, we have a very simple example here. Let's imagine shareholder 1 and shareholder 2 have been trading for a while in TradeCo, and they decide that they want to form a group for whatever reason. Maybe they want to move some assets up away to protect them from TradeCo's risk. What we would generally do is we would have the two of them form Holdco. So shareholder 1 and shareholder 2 form Holdco. And let's assume TradeCo has 100 shares and they own 50 each between shareholder 1 and shareholder 2. Holdco is formed, usually with 1 share each to shareholder 1 and shareholder 2. Holdco then offers to buy TradeCo, but of course Holdco hasn't got any money. So what it does is it issues shares to the shareholders of TradeCo in exchange for their shares in TradeCo. So effectively you do a share swap. Shares are issued from Holdco to shareholder 1 and shareholder 2, and TradeCo hands over, and shareholder 1 and shareholder 2, hand over their shares in TradeCo to Holdco. And as a result of that transaction, Holdco ends up owning 100% of TradeCo. Nothing's changed in terms of the ownership. Shareholder 1 and shareholder 2 but still own 50-50 in Holdco, which owns 100% of TradeCo. Now, transactions like that as you'll have picked up from previous webinars, would invariably have some tax consequences. At the end of the day, the shareholders have sold their shares in Tradeco to somebody else, which is Holdco. Why is there not a capital gain there? Well, the answer is, as you can see on the screen, there is a whole raft of reliefs and exemptions that allow us to do this. In simple terms, we are allowed to do this with hopefully no tax cost. There is, however, a bit of work at our side because we do have to make sure we can fall within those various reliefs. So there's the transaction securities rules, there's the Section 138 capital gains tax holdover rules, and then stamp duty acquisition relief as well. All those taxes have separate reliefs which we claim. We have to do separate claims for, and we can actually get clearance in advance for most of these as well. So it's something that we can do with a fair degree of certainty by the time you come to it, but just don't expect it to be done without a little bit of effort because there are some hoops to hop through. So that's in essence how you form a group. Let's look now at tax reliefs and exemptions. So the legislation sets out, well, I'll go back one step actually before I say that. It's all right, the slide's fine, James. The legislation sets out a number of reliefs, but just before we go into those, you might reasonably think that once you've got a group, that the tax reliefs for corporation tax on gains, tax relief for corporation tax on profits, and tax reliefs for moving of assets around the group, etc., would all be largely the same in terms of what is a group. And we haven't really touched on what is a group for these purposes. So here's where we start looking at it. And you find it's inevitably, with any sort of tax relief, it's not as simple as it perhaps could be or perhaps should be. But then that's the world of tax, isn't it? Nothing's ever straightforward. So the main reliefs are group and consortium relief. This is the relief for losses, basically. If a member of a group or a member of a consortium, and I'll mention what a consortium is a little later, has a loss, then provided they're in a group as defined for this purpose or a consortium as defined, then that loss can potentially be surrendered to other group or consortium members. And there are certain rules we'll go through on that. Then we have chargeable gains groups. Now, chargeable gains groups are slightly different to groups for corporation tax purposes. They're fairly similar, but they are a bit different. So again, we have to look at it slightly differently. But that allows assets to be moved around a group without giving rise to tax charges. You don't actually surrender capital gains losses or capital losses between group companies, although you can achieve much the same result via a slightly more convoluted process. When you buy and sell shares in companies, you would expect to be paying stamp duty. Again, within a group, there is a relief for that. So we can claim a relief if you're acquiring shares in the company from another group member, then you shouldn't have to pay stamp duty, provided the relief is claimed. And if you're moving property around a group, stamp duty land tax would be chargeable as well as capital gains, etc., unless there was a relief, and there's a specific relief for stamp duty land tax. And then we have the substantial shareholdings exemption, which allows for tax-free disposals of subsidiaries in the right circumstances, and James will give you the detail on that. So let's look at group relief, which is the main one, I suppose. So we're finally looking at what is a group for this purpose. So to qualify for group relief, that's a relief for losses, trade losses, that is. It needs to be a 75% group. So your parent needs to own at least 75% of its subsidiary. And if you have a line of companies, we showed a vertical group in one of the examples earlier, you can see the example put there on the third bullet point. If company A owns 90% of company B, those two companies are in a group for corporation tax purposes, for purposes of group relief. If B then owns 80% of C, C is only owned effectively by A as to 90% of 80%, which works out at 72%, which is less than 75%. I'm sorry about all those percents. If you follow that through, you can see that C is not within the corporation tax loss group of A. It might be within the corporation loss group of B, but it's not with A because it needs to be 75% directly or indirectly. Once you are within that group, within a 75% group, then you're into the ball game or the ballpark for actually surrendering losses, although there are one or two other hoops, which we'll come to in a second. Consortium relief is something that I've very rarely come across in the 30 odd years. So it's not something we see too often, but it does happen. And this is where you have a company which is not a 75% subsidiary of anybody, and at least 75% of its shares are owned by different companies, none of which owns less than 5%. So in other words, if you're one of the owners of this company and you've got more than 5%, and if 75% of that company is owned by such companies, and it's not owned 75% by any single one company, and that's a bit confusing, then a loss from that company can potentially be surrendered in proportion to your shareholding and your profit to your particular company, and vice versa. So it is potentially a useful relief, but the one we see invariably, or almost invariably, is the standard group relief. So I mentioned there were some restrictions in what you can do. Having got yourself within a 75% group, you then have to look at what is the maximum surrenderable amount. So firstly, you look at what losses you can surrender, and the losses of the year you're in, you can certainly potentially surrender. There are certain losses brought forward from post 1st of April 2017 under new loss rules that you can also surrender, but prior to that, you couldn't. So current year, you're okay. Brought forward losses, we have to look at a bit more carefully. So you've established you've got some losses, and you've established that you're in a group, so it looks good so far. What is the maximum surrenderable amount? Well, that is the lower of, if you're talking about two companies that have the same year end, it will be the amount of the loss or the amount of the profit in the receiving company, whichever is the lower. So you can only surrender losses up to the amount of the profits in the receiving company, which makes some sense, although you could perhaps say, why not surrender it all? And they could carry it forward, but you can't do that. So that's one limit. If you then look at a situation where you don't have the same year ends within the group company, so let's say holding company has a year end of 31st December and surrendering and subsidiary has a year end of 30th of June. If you look at you have to find what's called the corresponding accounting period. So you look at a year to 31st December, you look at the year to 30th of June, and it's fairly obvious that 6 months of each company's accounting periods overlap. And only that overlapping bit you look at. So if you have a gain or a profit of 200,000 in one company and a loss of 100,000 in the other, you look at 50% of 200, you look at 50% of 100, and it's that £50,000 of loss, which is the lower figure of the loss or the gain or the profit that you can surrender across. Equally, if you had a loss of 200 and a profit of 100 in the other, then half of 100 is £50,000. So the most loss that can be received by that company would be 50, and the loss at the other company that was corresponding would be half of 200, which is 100. So you'd think you can do 100, but it can only be the 50, which is the equivalent figure. It's the lower of those two numbers. So I hope I haven't confused you too much there, but it's that corresponding period that we have to look at. You can, between companies, pay for group relief if you wish. And if you do, it's not taxable or deductible. And I've put cross-border issues there, but that's largely irrelevant. You generally can't move losses across borders. There was a period when you could in Europe to a degree, but it's largely not something that you can do. So this is a larger UK-centric point. So I mentioned that there is a difference between the corporation tax side, the trading profit side, and the capital gains side. And this slide is trying to demonstrate that. If you remember, with the profit side, you need to have a 75% group. It needs to be 75% all the way down, so 75% effective ownership. With a capital gains tax group, it's a bit wider than that. You do need to have a principal company with 75% subsidiaries. So you need to have that 75% link at that top part of the chain. But it's possible that a 75% subsidiary can own its own subsidiaries, and provided those sub-subsidiaries, if you like, are effectively owned by at least 51%, then it's still in the group. So in this example, company one owns 75% of company two, so it's a principal company, it's at the top. Company 2 owns 75% of Company 3, so that's still within the Company 1's group, because if you look down that chain, 75% of 75% is 56.25, which is more than 51, and therefore companies 1, 2, and 3 are in a capital gains tax group. But when you get down as far as Company 4, which is owned 75% by Company 3, it cannot be in Company 1's group, because that's less than 51% effective ownership. And it also can't be in a capital gains tax group, as it happened with Company 3, because a principal company cannot be 75% owned by another company, which of course Company 3 is in this diagram. So that's the difference. You can go down effectively one more company in the chargeable gains group scenario. If this was a trade profits example, then only Company 1 and Company 2 would be joined together for loss purposes, for trade loss purposes. So that's useful to know. And I mentioned, if we go on to the next slide, you can't surrender capital losses between group companies, but what you can do is move assets from one company to another without there being a tax charge in effect. So that allows you to effectively move something which has an inherent loss into another company, and then realise that loss potentially there if that's what you want to do. So it's a slightly more convoluted way of transferring a loss from one company to another. What you can also do is realise a gain or a loss in one company, and then elect to treat another company in the group as the company that's actually made that loss or made that gain. So again, through a different and more convoluted route, you can in effect move losses around a group, but it's not as flexible as trade losses, because with trade losses you can put a little bit here, a little bit there. If you've got multiple companies, with chargeable gains and capital losses, you can't do it quite so flexibly. As you might expect, there are all sorts of anti-avoidance rules to stop people buying losses of whatever sort in other group companies, but we don't need to, I think, go into that in any detail today. Move to the next slide, please. This is my final slide, and I've mentioned already that there are reliefs within groups for stamp duty and stamp duty land tax. Just to remind you, stamp duty, you still pay stamp duty when you acquire shares in another company, or you might do, but within a group structure there is a relief, it's there on the screen. And when you're moving property around a group, we know there's no tax on capital gains, etc., because there's reliefs within the group, provided you're a capital gains group. But there could well be stamp duty land tax, and again, there's a separate relief covering that within a group. There are restrictions. You can get clawbacks if things change within a 3-year period, but in essence, you can claim a relief. And at that point, I think I've gone longer than I should have done, so I shall hand you over to James to pick up on substantial shareholdings.
Thank you, Patrick. Your reference to consortium relief took me back to doing my exams 10 or 15 years ago. I remember dreading a question on consortium relief. Anyway, let's move on. The last of the reliefs we'll discuss is the substantial shareholdings exemption, or SSE, as I'll refer to it over the next couple of slides. Where a company holds at least a 10% shareholding in a trading company and has done for at least 12 months out of the last 6 years, it will pay no corporation tax when it sells that investment. It's important to emphasise the trading requirement, and that doesn't actually come across on the slide here. For the company invested in, so it's the company that we're investing in, so the investee company, that must be a trading company, because the relief is not available on the sale of a shareholding in an investment company. So in the example on the slide here, each investee company or subsidiary is likely to be undertaking a different trade. If one is sold, in this case subsidiary 4 or investee company 4, the proceeds arising to the holding company will arise without a tax charge and then can be reinvested around the group. Obviously, there'll be a tax charge if the proceeds are extracted from the group, but the purpose of SSE is to ensure there's no tax liability arising on the disposal of essentially a subsidiary company, and then, of course, the reinvestment of that money into the group's other activities. In the previous example, so in the example I just discussed, the group structure is already in place, with the holding company and separate subsidiary companies for each trading activity, therefore allowing easy access to SSE in the event of the sale of one or more subsidiary companies. However, there could be an opportunity that comes along to sell part of a business without the activities having been separated into different companies before that offer comes in. So In that scenario, there's an extension to the basic SSE rules, which allows the transfer of part of a group's activities to a new subsidiary immediately before a sale. So if we're not currently in a position to benefit from SSE, it's still possible in these circumstances that I will explain to access that relief if you're selling perhaps a division of a trade. Where was I? So the extension of the relief. So if we transfer part of a group's activities to a new subsidiary immediately before a sale, the sale of that subsidiary immediately qualifies for SSE despite the normal 12-month ownership requirement not having been satisfied. So, as I said, for example, if you have a company operating several trades, one can be hived off and sold with the benefit of SSE. And an example I advised on recently was an estate agency which operated a letting business as a division of the main company. They received an offer for the letting business, so that was hived down into a new subsidiary and we sold that with the benefit of SSE. The one quirk here to this rule is that there must be a group in place for 12 months before a sale, even if that group does not include the new subsidiary. So in my client's case, it was easy because they already had that holding company with trading subsidiary structure in place, albeit the trading subsidiary undertook several activities. But the planning point here is if you have single companies, it's often advisable to have a dormant subsidiary. So just incorporate a dormant subsidiary and leave it there, which shouldn't add much in the way of costs. And that creates a group and therefore facilitates access to SSE under this rule, should the opportunity ever arise. Now, groups and IHT. So in advising private clients, we spend a good deal of our time considering the tax efficiency of group structures from a capital taxes perspective, particularly inheritance tax. It's also relevant for capital gains tax as well, and entrepreneurs relief, or as it's now called, business asset disposal relief. In terms of inheritance tax, though, integral to the tax efficiency is access to what we call business property relief, which is 100% relief or up to 100% relief in relation to property consisting of a business or an interest in a business, including shares in unquoted companies. Now, the business or company must be wholly or mainly trading rather than making or holding investments to qualify. And in this context, mainly means more than 50%. So we spend a lot of our time looking at companies and looking at groups and saying, do we satisfy that mainly test? Okay. Now, that mainly test is analysed by looking at the following 5 factors as determined by the several leading cases, and one of which is mentioned at the bottom of the slide. But the following main 5 factors are the overall context of the business. So that's, what does the business look like to the layperson, to someone looking in on the business? What capital is employed? So, or rather, is capital employed in trading activities or investment activities, or a mixture? How is that mix? The time spent by employees. So do employees generally spend their time on the trading activities or the investing activities? What's the turnover and what's the profit? How is that split between trading and investment activities? And you have to look at everything in the round. I would say that perhaps turnover and profit are kind of looked at in priority, but that's not necessarily the case. It's necessary to look at the business or the group in the round. In the case of group structures, though, the shareholder's investment is in the holding company. And in the context of IHT, this would normally be an investment company. However, the rule against investment businesses does not apply to holding companies. So this helps groups, provided the business of the company, that's the holding company, consists wholly or mainly of being a holding company of one or more subsidiaries who undertake qualifying trading activities. So what does this mean? And it's actually quite a complex point, and there are a number of quirks that make it necessary really to look at every group structure to ensure that we're as efficient as possible. So I'll try and explain what I mean by this in several examples. I think I've got four examples over the next 4 slides. So in this example, we have a holding company with trading subsidiaries. Subco A and Subco B are wholly owned. but C is not a true subsidiary as it's only a 40% holding. So for this purpose, because it's not a true subsidiary, it's treated as an investment by Holdco, even though it's a trading company. So A is clearly trading and B is mainly trading. While C is trading, it's treated as an investment. So because the combined value of A and B at 1.45 million is less than C at 1.5 million, Holdco is not mainly that of being a holding company of a trading group. So no BPR would be available, no business property relief is available, and the whole value of this group is exposed to inheritance tax for the shareholders of Holdco. So in this case, we'd probably recommend some restructuring, and I'll come on to that in the final part of the talk once I've gone through these next few examples. But you can see that that almost presents an illogical outcome. This is the same as the first example, except the value of C is reduced to 1.4 million. So C is still not a true subsidiary, so it's still treated as an investment. But if you look at the values, the value of A and B, which are mainly trading, is 1.45 million compared to C at 1.4, and therefore the holding company is now mainly the holding company of a trading group. And almost perversely, compared to the first slide, in these circumstances, BPR would be available in full in relation to the entire value of Holdco. So the entire value of Holdco is sheltered from inheritance tax for the shareholders. And as I say, the contrast with example 1 is stark, despite just a modest change in the circumstances, and all the investment assets are sheltered from IHT. Example 3. So let me see. In this example, the only difference is that C is now a wholly owned investment company. It's therefore now a true subsidiary of the group. So Holdco remains mainly the holding company of a trading group because the value of A and B exceeds the value of the investment subsidiary. So in this regard, it's the same as example 2, except subco C is 100% investment. However, because subco C is a true subsidiary, there's a separate restriction which applies to the BPR availability, and it denies relief to the value of a subsidiary, so that's a more than 50% investment, whose business is wholly or mainly investment. So in this case, BPR is available on the value of the group, except the value of subco C is carved out and relief is not available. Perhaps actually that's a more logical outcome when you look at the makeup of the group. And in the final example here, C remains an investment company, so compared to a trading company in the first few examples, but it's not a true subsidiary because Holdco now has only a 40% shareholding. So this means the investment restriction mentioned in the previous slide cannot apply, and the value of C cannot be denied BPR. So even though C is an investment company, the group, however, is still mainly the holding company is still mainly the holding company of a trading group because the combined value of A and B exceeds C, so BPR is available in full, despite the overall value of the investments in this case exceeding the value of the trading activities. So if you look at the value of investments of C at 1.4 plus the investments within B, 350k, that combined value exceeds the value of the trade across the group. But because of the quirk in the rules here, BPR is available in full. So you can see it's not straightforward, and in some cases the rules give completely illogical results. So this does mean there are often situations where we need to restructure groups to provide better access to inheritance tax reliefs, and this leads me nicely into the final section on demergers. So just to introduce this section, although I've introduced this as being restructuring required to provide better access to inheritance tax reliefs in some circumstances, the principles here apply broadly equally in other situations. So perhaps where two trading activities need to be separated, or if there is to be a partition where a group is split between two or more shareholders. So the slide here introduces the different types of demerger where we're breaking a group up or splitting a group up. A detailed analysis of this is beyond the scope of this talk, but the basic principle is that there are two types of demerger. Statutory demergers at the top of the slide there, which are more straightforward, but only apply where both demerged businesses are trading. Okay, there are also strict conditions, etc., but I shan't go into the detail. And that compares to non-statutory demergers, which are typically used when one or more of the demerged businesses is an investment business, and typically they're more complex, and there's much more involved from a tax perspective in non-statutory demergers. There are a couple of types or typical types of non-statutory demerge, and I could talk about Section 1110 liquidation demergers or capital reduction demergers, but the principles in terms of what we're trying to achieve and what the end result is are broadly similar. So I'll briefly run through how we do a capital reduction demerger to separate out an investment activity from a group, just by way of an example. So in this example, and it's similar to one of the examples given earlier, BPR would be denied because subsidiary C is regarded as an investment, even though it's a trading company. It's regarded as an investment because it's only a 40% holding. And it means in this case, because of its value, the group is not mainly trading. Therefore, because it stops BPR being available on the other interests, the shareholders may want to take that company out of the group so that BPR is available on Holdco with just A and B as subsidiaries, so Subco A and Subco B. If the company, that's Subco C, was merely transferred out of the group, that would be deemed to be a taxable distribution equal to the value of subsidiary C or Subco C. So we must structure the transaction to be what we call a scheme of reconstruction, so that provided clearance is given by HMRC, and that requires us to show that there are bona fide commercial reasons essentially for undertaking the demerger, distribution treatment does not apply on the transfer of that company. But it's a reasonably complex process, and there are 5 basic steps which I'll illustrate in the heavily simplified slides that follow. So first slide. So step 1 in this type of transaction would be to insert a new holding company above the group using a share-for-share exchange, as in the same way as Patrick explained earlier. So this results in the slightly modified structure on the slide here. Step 2, Subco C, that's the company we eventually want to take out of the group, is then transferred up intra-group to become a direct subsidiary of the new holding company. So this is done without tax liabilities, using the intra-group reliefs from capital gains tax and stamp duty that Patrick explained earlier, and I've listed them at the top of the slide here. Step 3, we would then redesignate the shares in the top co, so new holdco, into perhaps A and B shares, with, for example, A shares giving rights to Subco C and B shares giving rights to everything else. So the shareholders in new holdco have now got 2 types of share, one share giving rights essentially to Subco C and one share giving rights to everything else. As step 4, we would then incorporate a separate company outside of the group, and for this purpose I've called it Demerger Co. Okay, and you can see here we've got the A shares and the B shares on top of new holdco and the group structure on the left. And as the final step in the transaction, this is essentially the main step which splits up the group. We then reduce the share capital of new holdco as is permitted by the Companies Act by the value of subsidiary C. So in this example, in satisfaction of this, the A shares are cancelled, and as consideration, the shares of subsidiary C are transferred to Demerger Co, with the new shares being issued to shareholders. Okay, this is what we call a scheme of reconstruction that qualifies for that no disposal and no distribution treatment for tax purposes. I think despite my best endeavours, I think I've got the A's and B's mixed up, but hopefully you get the principle. So the result, anyway, is shown here on this final slide. It leaves, therefore, a trading group on the left qualifying for BPR, and the investment group does not, but crucially, it doesn't cause the trading activities on the left to be denied inheritance tax reliefs. So it's important to emphasise that this is just one example. You know, similar reconstructions can be done in other circumstances, and of course, each transaction should be the subject of separate advice. I'd say that whilst the principles are fairly well established, no two transactions or no two reconstructions are the same. So on that note, sorry if I lost you with some of those examples, we come to the end and we're happy to take questions.
We have a question that's come through that I can see, and I know that Steve is, I believe, going to be asking a few more questions that have come through that he's kept track of. We've had a few, for those listening, we have had a few technical problems this morning as well, not as bad as last time we tried to do it, of course, but one of our team hasn't managed to get in for some reason. So he will be, I think, joining us by phone. But before we get to that, there's one question I can see. And this might actually, James, be more one for you because it's on the demerger side of things.
Oh, yeah.
But and no doubt we'll need more information. But if I just give you the facts here. We have someone who says he owns a property business with a business partner and he wants to demerge by splitting up the properties. So I'm assuming they're going to have one set of properties going one direction and the other going the other.
Yeah.
He says he's already got a separate limited property business and he's asking, would he need to set up a new limited business for the demerger, or could he adopt into his existing business? Now, what he doesn't say is whether the current business is the company, but I assume it is for this purpose.
Yeah, if it's not a company and if it's a partnership, there's the issues are very different. But if we've got a property company, so property rental company, investment company, owns, let's say in this instance, 50-50, it is possible to partition that so that you end up with each 50% shareholder holding their own 100% company or group. Okay, and typically in advance of that, the shareholders would determine which of the properties the one of them wants to take and which of the properties the other wants to take. And one of the most important things to think about when planning that type of demerger is how we move properties around in the group before the demerger, because we want to ensure there are no intra-group transactions that would cause stamp duty group relief to be denied or withdrawn at the point of the demerger. So without going into too much detail, typically what would happen here is we'd put a holding company above the property company, we'd determine the split of properties, we would hive up one half of the property portfolio to the new holding company, and then we would demerge the subsidiary that holds the remaining properties. I think that's possible without tax liabilities. Then there probably would be a stamp duty charge at 0.5% on the value of the demerged business, and that's probably unavoidable, I think. But in the scheme of things, that's relatively low. And to answer the specific question, could you demerge out into an existing company? Yes, you can. So in my example, where I referred to incorporating Demerger Co as a new company into which the subsidiary was transferred, that Demerger Co would just become the existing company of this particular individual.
Yeah, there was actually a sort of related question linked to that, which was to do with the stamp duty side of things, which I think probably you've covered. So the stamp duty side is a bit less well covered by these reliefs in a demerger, isn't it? But there's it isn't too painful.
Yeah, as a general rule, you want to, when dealing with property companies and extracting in property investments on a demerger, you want to minimise the intra-group transfers before a demerger. And on the whole, you can't avoid stamp duty entirely.
Right, I'm just trying to see if we've got other questions that I can access. do we have Steve on the line as yet with any questions?
I am here. Can you hear me?
Yeah.
Yes, we can. Yes.
Oh,
So
right. Sorry about that. I'm afraid I haven't heard all of the webinar. As you know, I've had one or two technical difficulties, so my apologies if any of these cover and include anything that's already been covered. I'm just working by email and messages largely, so I can't really hear too much. But a couple of people have asked, really going back to basics. One person in particular has several separate companies. So the questions really revolve around how easy is it to form a group? How's it done? What are the obvious disadvantages? Are there costs? Are there lots of tax costs involved? So if you've covered that, I'm sorry, but there are a couple of questions of that nature.
Well, I think we have largely covered the basic formation of the group, how you do it by forming a new company and doing a share-for-share exchange in effect, and the advantages of it. Disadvantages, I mean, I think you wouldn't do it if there were disadvantages. I mean, generally speaking, the reasons for forming a group they're all advantageous. I'm not sure there's any particular disadvantages. Can you think of anything, James, other than some quirks perhaps with the inheritance tax side of things?
Yeah, not really. I mean, yeah, obviously you've got to look at the efficiency from a capital taxes perspective. You know, and I suppose if you envisage well, at least in the short term, that a particular entity might be sold off, then personal ownership, so outside of a group, might be preferable. But as long as you plan well enough in advance, you can break up a group in the manner I've described at the end of that talk anyway. So I think with proper planning, you're probably right that there's not many disadvantages.
Right, thank you. There are, I don't know if you've covered overseas issues at all, but we have a question. Someone has a subsidiary in Spain, which I think is probably a trading subsidiary. And how does that affect matters, the fact that it's resident in Spain rather than in the UK?
I'll jump in first, Patrick. From a capital taxes perspective, so inheritance tax, capital gains tax, it doesn't. So if I'm looking at things from the shareholder perspective and their inheritance tax and CGT position, it doesn't affect things. Do you want to cover the corporate side, Patrick?
You basically, we're looking at losses, aren't we? I don't think you can surrender losses from a Spanish subsidiary to your UK group. There was a relief while we were members of the EU, and I'm happy to be corrected here, but there was a relief. You were able to use losses in an EU group member while we're in the EU, but it was very, very hard to actually get the loss. You had to exhaust all possibilities of loss in the host nation before any loss could be relieved. It was something like that. So I never actually saw it in practice being used. I don't know if you did, James, but I certainly didn't. So effectively,
I mean, again, correctly, Steve probably knows better than we do, but it was virtually impossible, wasn't it? It's the old Marks and Spencer case kind of said we can use it, but you know the situations are so, the circumstances are going to be so rare that in practice we never saw it.
No, I think
I have got one more question I can see here as well, just before Steve goes on. Holdco A owns 200% subsidiaries. One's trading, which is B, and the other is itself 100% holding company, C of a trading company, D. I'm just trying to follow that through, actually. So A owns 200% subsidiaries, one trading, B, and then the other, which is 100% holding company of a trading company, D. So I suppose, yes, okay. So I think we're saying we've got a topco which owns two subsidiaries, and one of the subsidiaries itself owns another 100% subsidiary. So four companies in the group. A owns B, A owns C, and C owns D. C holds the trading premises of D and charges market rent. Does this cause any BPR problems?
No. So if any property held in a company as an investment is used in the trade of another group company, then it doesn't cause there to be any restriction for BPR or what have you. So that's one thing. And the fact that you have that kind of linear arrangement on what I've got in mind, as I'll scribble this down the right hand side of the group, I don't think that causes any particular problem. And you're looking really because the two companies with the the main activities are ultimately, even if indirectly 100% owned, and they're trading companies, I think we should have BPR available in full. Do you follow that, Patrick? Is that right?
Yes, I think so. Yes, that made sense to me. Yeah. Did you have any more, Steve?
Well, actually, I've just had a nudge from the person with the subsidiary in Spain, because clearly I didn't make the question clear enough. Does it qualify for SSE and BPR? I think that's what they really want to know.
Well, SSE, yes, there's no, as far as I'm aware, there's no territorial limitation to SSE. So if a UK holdco sells a Spanish subsidiary, then there is no UK corporation tax on that, provided all the other conditions, so the trading condition, ownership requirement, etc., satisfied. BPR, again, if we've just got a shell holding company with a Spanish trading wholly owned subsidiary, then no reason why BPR doesn't or shouldn't apply, because again, there's no territorial limitation to that relief.
Another question.
That was the question, actually. Yeah, thinking about it. Yeah.
Steve, I mean, another question I can see here as well. When you are saying the value of trade and value of investment on the slides, is that profit, assets?
This is sorry. I perhaps should have said. I mean, I think I did caveat in my slides, so they're heavily simplified. I've put value to try and simplify things. Really, you'd be looking at all those factors that I explained in the first slide for BPR. So it's not just value. Value is one way of looking at it, but you'd be looking at profit, turnover, time spent, capital employed, and you determine kind of to what extent a company is trading and to what extent the company is investing. And then you'd apply the principles that I explained. But I simplified those examples by taking just the value. And I think actually that's taken straight from HMRC's guidance, I think. Don't quote me on that. Yeah, hopefully that explains where I was coming from.
Thanks, James. Yeah, I've just found another question buried in our chat rather than the Q&A. So trying to evade me, but I've managed to find it. Which is, could you again explain the significance of a 51% holding in a 75% group structure for loss relief purposes? And the reason the question's been asked is there was a break in the sound, so we had the classic Zoom call breakout of sound, I think, at that point. I think perhaps what you're talking about there is the capital gains tax loss group, where the group needs to have to qualify for capital gains, to be a capital gains group. Basically, you need a principal company which owns at least one subsidiary 75% or more. Once you've got that, then you've got a capital gains tax group. And then if the subsidiaries own companies that underneath them, so there are sub-subsidiaries and they don't own them 100%, then you have to look at the effective ownership. So I think the point I was making was, if you have a company which owns another company 75%, that is a capital gains tax group. If that second company owns a company below it 75%, then that is still a capital gains tax group, because the top company owns 75% of the one down, and that owns 75% of the one below it, which means the top company, in effect, owns more than 51% of the third company down, because it's 75% of 75%. Now, in the example I put up, we then had a fourth company, which was owned 75% by the third company. Sorry, I'm doing this from memory now. Now, that fourth company is not in the capital gains tax group, because the effective ownership, once you've gone 75% of 75% of 75%, is less than 51, and that was the significance of the 51% holding in the 75% group. I hope that helps a little, but by all means, send an email if that still doesn't explain things to you, and we'll have another go. I think that probably just about brings us to the end of questions, and we're just about the end of our time. Did you have any more, Steve, or are we about there?
No, I think that's probably it. There are one or two quite detailed ones about the accepted asset rules, which I think we'll probably answer individually, I think, and a few overseas ones, but referring to specific jurisdictions for which we'd have to look at treaties, etc. So they're probably too complicated for this context, I think.
Thanks, Steve. Actually, I've just found one more. We have a minute or two left. This is an extension to the demerger question, James, that was asked earlier.
Oh, yeah.
I don't know if this is one we'll be able to answer quickly, but can you extend the timeline of a demerger over a longer timeline, i.e. 5 years, to save on costs for redemption fees from mortgage lenders for properties? Or do you need to do a demerger at the same time within, say, 3 months? Are there any issues with either option?
I hope I've answered the question correctly. I think someone's saying that, perhaps ideally they'd undertake a demerger, but they've got a load of borrowing and they would have to wait,
That's what I'm thinking.
for the an appropriate time to avoid penalties. I mean, I think extending a demerger over 5 years is not practical, and it would be a case of waiting until the appropriate time to undertake the demerger. I suppose I would also say, though, that it might be the case that the ownership of the properties, or rather the ownership of the properties the subject of the early redemption penalties, might not change. It might be the ownership of the company that changes. So the properties might stay where they are, or at least a large chunk of them. So I suspect it's one of those cases where we'd need to look at in a bit of detail to determine when is the earliest we could undertake a demerger to avoid early repayment charges. Happy to have a chat with the person who's asked that question. I think that's probably the best way to answer that one. Sorry.
Yes, well, that was my thinking. We probably need to know more, don't we? But yeah, it's tricky, I think, is the answer. And actually, there's one more. This will be the last one because we're running out of time now. But this is a bit more of a technical question, I think. If there are plans for selling the demerged business following a demerger, is there an angle to still do statutory demerger to separate the trades? At what stage can the plans or intentions to sell be to still qualify for statutory demerger? Yes, I don't quite follow that entirely, but I presume they're saying if you plan to sell, can you still do a statutory demerger?
Well, firstly, you've got statutory and non-statutory demergers, and if there's any chance of a sale or a sale anticipated in the 5 years after a demerger, then typically we would not recommend a statutory demerger because of some anti-avoidance rules within those provisions. So we would probably then recommend a non-statutory demerger, and unless we are at a point where we are pretty advanced with the sale at the time of the demerger, so there's non-statutory demerger. As long as we're not in that position, then we should get clearance for a non-statutory demerger from HMRC. So I perhaps didn't articulate that very well, but basically what I'm saying is, if you envisage at some point, in the foreseeable future, but there's nothing in progress and there's no heads of terms and all that sort of stuff, then you should still be able to undertake a non-statutory demerger to separate trades, provided there's kind of overriding commercial reasons for doing that. If we are already at the point of a sale, then typically that would be well into discussions with a potential purchaser, then we might struggle to get clearance from HMRC for a non-statutory demerger, purely because the overriding reason for the demerger at that point is likely to be to get the shares of the company to be sold into separate ownership, rather than for any commercial or business reason for the group. You see what I mean?
Yeah, no, that makes perfect sense. The point is there's loads of anti-avoidance from the statutory demerger, so you'd probably go another way, but even there you have to be a bit careful, I think.
Yeah.
Summarise it.
But we have done demergers in cases where the shareholders or directors anticipate a sale in the sort of coming, let's say, 2 to 3 years, and we're quite open with HMRC in our clearance application that is a possibility, but there's nothing yet on the table. And provided there are commercial reasons for the demerger, in any case, clearance is generally forthcoming.
Well, I think that is about all we have time for, and I can't see any more questions. Apologies if we've missed any. We will try and get back to people if we've missed something at a later time. That brings us to the end of this session, which is the last one for this year. I think we'll be restarting in February rather than in January. All I can do now is wish you all a good Christmas. I hope our friend Omicron doesn't disrupt things too much, and that we have some normality. But otherwise, look after yourselves, and we will meet again, no doubt, in the new year. Thank you very much.